us and the collaboration we're going to have going forward.
No better way to communicate to your audience.
How do we grow strategically now that we've gotten the right path forward? Hey guys, hope you're doing well. Here with Agents Who Win, Todd, Schroth, and Laurence Heisler. Laurence is our mortgage originator or mortgage loan officer, or what's your title?
Let's go with loan originator.
The loan originator. There was another term for that with like the horse and cowboys or whatever. But I can't remember what that was. Or somebody else used it before.
Loan arranger or something.
Loan arranger. That's what it was. I want to thank everyone for being here today. This is an interesting market we're going into, and actually diving into our show on Agents Who Win. If you haven't subscribe to us on YouTube, Facebook, and or Instagram and LinkedIn. You guys should be seeing this show, and we're now officially on podcast. So check us out on there as well. So Laurence, I appreciate you jumping on today. We're going into this this show today with just want to find out what's going on in the mortgage markets, and we're seeing a lot of fallout from realtors and from mortgage loan officers or mortgage brokers or anybody in the mortgage and real estate business is coming out. They're getting out of it because they just can't sustain. And like any business, there's an 80% fallout. How do we stay in this business, especially with what I actually call a good market? It's not a shift; it's a normalization. So let's just dive in first and let's talk, let's maybe get excited about interest rates. What's going on there first?
Yeah. So obviously it's been a wild ride this year with interest rates. We've seen some historical things happening with the rates going up and the Feds, raising the rates and everything. But I'll tell you, Todd, we're looking back at charts now. I just saw one yesterday that went back about 3 decades, and we're still right near the bottom as far as the best rates available in the history of mortgages. So it's all relative. I mean, we've been spoiled, and what we've found out is that the rates have been artificially held low the last few years, in part by the government buying back mortgage-backed securities, and so now we're starting to see the market where it should be. And look, this is a good thing. I mean, I can tell you, our leads are up right now. We've got more buyers coming back into the market because there's less competition to buy. So we're seeing some good things because of the increases of interest rates.
And it's funny, on our end, we've lost a lot of buyers, but we're actually busier now than we were a month ago. And because less competition. It's when I walk in on Monday and I see we have 5 new contracts versus in May, we're walking on Monday and we see like one, and that buyer canceled on Tuesday because he decided he didn't want to buy the house anymore. It's actually pretty good. See, one of the loan officers that sent me an email, he put a thing out the other day, and he was talking to a group of realtors, and you've got people that have been in the business 30 years and been in the business, for 2 years or a year, and they go, if you go across the last 100 years, what's the average interest rate it has been? And someone's like, 3.5%? Like, no. 6.5% was the average going across however many years or however many decades that they tracked, and which is what we're at right now. So we're at the average interest rate, and everyone's posting right now, we're not married to the rate, but we marry the house. We can always refinance for a variation of reasons, and rates go down, cool, let's refinance. So that's kind of cool that we're at that average. I'd love to see them back in the 3s because I'd love to buy a house again at 3%, but you just got to time it. And if you buy it today at 6, it goes down to 3, refinance it.
Yeah. I mean, you and I have been in the business for a long time, so we've seen these fluctuations time and time again. This is nothing new. And it actually helps to kind of cleanse out our industries, both of us. I mean, you get a lot of people that come in when everything is good. And, these part-timers, these people that are kind of doing other things, they're not really true professionals in our industry. So I think this is good for both of our industries, and the true professionals, that top group that are willing to dig in right now and really put our time and work hard and help people. People are going to live somewhere, right? And so whether they're renting or whether they're buying, I mean, this is the time to educate, not the time to be scared about what's going on. And when you really show people the difference between what renting does and what buying does, for their life, for their financial situation, it's huge, regardless of where the interest rates are.
Yeah, there's another podcast that I was listening to. This guy Jesse, he posted, everyone's posting right now what the rates were back in the 1980s, 1970s, 1990s, that they were in the 6, 7, 8, 14, 18%. I remember buying my first house and I paid 3 points and 18%. That was back in 1995. Yes, the house was $20,000 or $25,000, but it was also a fixer. When I got the rates down at 12, I thought I hit it big. And then when rates were at 10, I was like, oh, this is amazing. And then rates, I got my first, like when I got a loan from Bank of America, it was 8.5%. I was like, man, I struck it. I just felt like good. I'm like, man, I got a single digit rate, with an 8 point something instead of like 10.5. I'm like, man, I'd love it, and then, obviously prices are relative, but, my parents who've been in the business for my entire life have, made the comments that, yeah, we sold houses at 18% and 14% and, paying 1, 2, 3 points. And they were still selling $300,000 and $400,000 houses at the time. Those houses are now worth $1 million, but they were still buying properties at that time at that rate. And we're not at 14%. So we're at, let's call that $150,000 house today is what, 400,000? I think people are still buying a $400,000 house at 6%. Yes, our approval went down 30%, and quote me if I'm wrong on the average there, but those buyers got to get out of the mentality that they're able to buy that $800,000 house now still for that same payment.
Yeah, and going back to what you said earlier, don't date don't marry the rate, you date the rate, right?
Yeah.
And at the end of the day, when these changes come around and we have the opportunity to refinance, anybody who's buying now will have that opportunity. And when that comes, could be a year, 2 years, 3 years, 5 years, we don't know, but it will come. And so I think going back to what the real reason is that you're buying right now is as important as ever.
Yeah, and it's and if you and I like that. Go back to the real reason why you're buying. Why do you need to move? If you don't need to move, don't. But there are people who've been waiting to move because they couldn't find a place to move to. So I actually like what's going on because it's allowing us to see more opportunities. I asked an agent earlier today. I'm like, you ever heard the word price reduction? What's that? And because I had to ask that because he's somebody that's been in the business less than 2 years, and they have to understand that, we're seeing a lot of listings pop up on our emails. And I was like, man, did they just get a new agent or is that a brand new listing or something? I'm like, no, the listing just got reduced on something. Agents need to understand the words price reduced now and how to have those reduction prices with their sellers when they said they're still on this, they still think we're in that up market. I was on a listing call last night for some people I'm meeting at the end of the week, and they go, is it still a good market to sell? And I'm like, I'm glad you asked me that instead of saying I want to take advantage of the market while it's up, because the market does shift, and it's not one that shifts, and you can agree or disagree on this, and I think you'd see the same story, that it shifts within weeks, not months. And I don't know what it is. That's the puppet master out there who says, all right, guys, we're done. They shifted it quickly.
Yeah, I think everybody likes to think that they're going to hit the market at the very top.
Yeah.
And when the sentiment starts to show that the market's leveling off, I think that creates a little bit more of a incentive for these sellers to, put their house on the market. And that's what we're starting to see right now. We're starting to see some more inventory coming in. And I think a lot of that is because sellers realize now that that crazy ride might be starting to level off right now. So that's good for buyers, you know?
Because it's competition. Now we are still seeing multiple offers on our listings, and I want to, not get everyone thinking this is like we're going to be, a house is 400,000, we're going to get it at 375. No, you're still probably going to pay 410 for that house if it's listed at 400, but you're not going to be up against 22 offers. And this is also a time where people need to educate their clients. Get your house in good shape. There's, whether it's pressure washing or it could be remodeling the bathroom or changing the carpet or doing stuff, they're not going to go in and offer crazy prices on those houses that need work. It could be doing some staging, could be spending a little bit of money on a listing to make it where it's going to sell for more.
Yeah, and on our end, what we're doing is we're just preparing our buyers for everything. If they've got a house to sell and they want to buy a house, Well, if we can get them approved to buy the house without having to sell their house, then that puts them in a much stronger position when it comes time to offer. And looking at some temporary financing options for them as well. So, like a lot of our clients, we've got the 80-10-10 loan back. So this is where we set up their first mortgage at 80%, and then we maybe do a second mortgage with 10% to where they're only bringing 10% down. That way, when they do sell their house, they can pay that second mortgage off, and they end up with the mortgage they originally wanted. So we're just going back to some creative ways to be able to help clients get into the ball game and ready to make an offer quickly on a house that comes available.
Are you still seeing people, running with like the ribbon or the knock program where it's like buy the house, then sell yours and use cash to purchase? Are you seeing the effectiveness of those programs right now still?
We are, yeah. I mean, one of the biggest fears that a lot of our clients have is being homeless, and they know how quick their house is going to sell. And so we had a client from New York that wanted to buy down here and move to Florida. They didn't want to be homeless, so they used the ribbon program to buy their house down here, and then they ended up putting their house on the market. Of course, it went quick. And they're going to close the end of July, and we're going to close right after on their house that they're going to then buy from Ribbon at the same price Ribbon bought it for. So we are still seeing Ribbon being used as a strategy with some of our clients.
It's funny. You think about it. I don't even think about it as a strategy anymore, but I think about it more as a convenience because I want to be able to, pay cash for the property, it's like buying it and selling. But if I can buy it with the cash, move into it, and then, use their money instead of going out and getting another loan. And if my house is paid off, then maybe I can use the cash from that, or I've got time to play with. But it's a good strategy to use as well because I don't need to qualify for both mortgages. And those of us that don't have the money to, make 2 or 3 mortgage payments, we can use that as, pay cash for the property and then get in and then sell ours, fix it up, sell it, and then buy the other one. I see a few new players coming to the market as well with that program, which I feel like they're late to the game, but everyone's trying to get a little bit more creative than the other person.
Yeah, I mean, I think a lot of today is going back to the basics as well. For instance, if I have a buyer that's pre-approved, we're going to call the listing agent. We're going to talk to the listing agent. In a lot of cases, they know me. I've been doing mortgages for 25 years here. So we need to instill that confidence that we've done a proper pre-approval and emphasis on the word proper, Todd, because there's a lot of lenders out there that you can get a pre-approval in 5 minutes, and that is not a pre-approval. That has not been reviewed by underwriters, and that makes a difference today. So we want to make sure to put our buyers in the best position to be able to buy, and those little things can make a difference when they go to make an offer.
No, I think it's huge. And that is where I think it's great now too, to be still keep local with your lenders, keep local with your realtors. I mean, we've got agents coming from Tampa up here to show houses and Miami driving up here to show a house. We don't know you. Make the process hard. Rocket Mortgage and these other ones that are the online lenders. You need to stay local with your stuff. And I think it's huge because relationships matter and the clients are going to realize that as well. I wonder if more listing agents are going to start answering their phones because they've been bombarded with 25 conversations or contracts. Did you get it? Where's my status, etc. Now it's nice to get back to I have 1 to 5 versus 5 to 25.
Yeah, no doubt. One of the things we're doing now, we just launched this a couple months ago. We've always been able to pre-underwrite certain items on a file, but now we've opened it up to the entire file being pre-underwritten. So we call it TBD underwriting, meaning a property to be determined. And this really puts our buyers in a great leverage position because they've already been approved for underwriting. So if they find a house, we can close inside of 2 weeks on that property. And there's no worry about their financing falling through because underwriting has already approved it.
So it's a typical, I just need an appraisal, insurance, and a survey and clean title, and we're good to go.
That's it. Appraisal and title, and let's close this puppy. Yep.
So this is a one-off question. We've seen a lot of, people have been doing appraisal waivers. They've been doing appraisal gaps and stuff, and which are great. But, and now with the market changing, we're not going to see the appraisal waivers, I think, as much, or the appraisal gaps, the gap coverage there. Are you still seeing a lot of where the lender is waiving the appraisal based on the automated value metrics and the buyer's credit?
Yeah, we just got one yesterday.
Oh wow, okay.
We celebrate, and the clients love it because it saves them about $475.
Yeah.
For the cost of the appraisal. But yeah, I mean, it's really, honestly, Todd, it comes down to how you guys are doing with pricing the home, and what you're coaching your clients on, advising the offer on the home too. And as long as it's in the ballpark, we've got a good chance of getting that property inspection waiver. So yeah, I mean, it doesn't happen all the time, but we're getting it probably one out of 4 transactions. I'd say we're getting that waiver.
And I don't know if you know the answer behind this, but what comes behind an appraisal waiver? Do you know like what the metric they're going off of? It's not Zillow, it's not real RPR, it's not the tax rolls. What are they trying to find on there? Because I know if it's a condo, the last 3-bedroom, the last 3 2-2s all sold for the same price, so I know we're pretty clear there. But if it's a house, it's harder to gauge unless it's the same model throughout the neighborhood. It's harder to gauge that exact number because Realtor.com, or not Realtor, but Zillow will have one number, RPR will have another number, and then the tax rolls, the AVM there will have another number. Sometimes they're all the same, but other times I'm seeing like almost $100,000 gap between all 3 of them.
Yeah, I mean, it's part of their AVM. So, and when I say they, I mean Fannie Mae and Freddie Mac. That's where we're getting the property inspection waivers, not with FHA or VA.
Okay.
But it's conventional loans. And they just have their system set up. I mean, it's part of their algorithms. And we don't know exactly what goes in, what properties they're looking at, or whether they're leaning on a certain site like Zillow or whoever to get. I seriously doubt it's Zillow, but whatever they're doing, whatever that AVM, that built-in comp system that they use, that's what they're relying on.
Cool. It'd be interesting to see what the metric is there. So if you do price something like, hey, I know this will price an appraisal waiver, but we don't know what Zillow does. We don't know what RPR does. We don't know how any of them are. It's just some algorithm that they use to make it work. And hey, when we get an appraisal waiver, we're excited about it because it is one less step to have to worry about.
Heck yeah. And the crazy thing is there can be things that can affect that property inspection waiver, even with the loan itself. This is the algorithm part I was referring to. It doesn't even really matter. I've had loans that we changed the loan to value, and all of a sudden we lost the property inspection waiver. So it's one of those things where when we get it, we kind of say, everybody freeze and just follow our directions and let's get this thing closed because we don't want to lose that. Because we know, obviously, an appraisal, when it's ordered, it's one man's opinion of what that property is worth. And you can get 10 appraisals on a property that come in with 10 different values.
Yeah.
And it's a little bit of a crapshoot when we get those appraisals back. So we just, we don't want to lose a deal or have a client lose their dream home because a certain person decided that property wasn't worth what it really is.
Well, I tell sellers, they're like, how do you feel about the appraisal? I'm like, I've had properties that have come in different square footage. I've had the same appraiser go back and measure the house 3 times, and he measured that wall different 3 times. How did that wall change from 50 feet to 55 feet to 47 feet? You have the same tape. Like, how does that happen? And we've had where they were literally $100,000 difference in values. And, the one guy said it's 36, the other one said it's 4,000. There's no exact science. And yet you all have the same tape measure. And it all depends on what they call the golf front value to the pool value to, the conservation view. What are all those worth?
Yeah. And if something's considered part of the house, or is it a mother-in-law suite, that
right.
can change the value. Now, I will tell you this, and this is, I'm so excited to bring this up. So 2 weeks ago, we had an appraisal come in under value. The listing agent and buyer's agent both said, no, we don't like this appraisal. We want to refute it. And they did. And they put together some other comps that they felt were better comparable sales. And the appraiser went from 15,000 below sales price to 5,000 above sales price.
Well, I got to give kudos to the appraiser for not keeping a thumb up his ass and being like, I'm the king. He actually listened to the people and looked at other, potential comparables that are there.
Yeah, yeah, it's nice to see, and I know they're humans, and for them to look and say, hey, you know what, I didn't see this,
Yep.
or maybe this wasn't available with the data I was researching. I mean, that's the other thing too. Sometimes there's sales out there that aren't on the MLS, and I always tell my agents, like, point that out to your appraisers. Let them know, hey, this sale was a first sale by owner down the street, and it's not on public record necessarily yet. So that can help for sure.
But this is why I always make a point, and I have for the last 10 years, when there's an appraisal happening at a house, I am there with the appraiser. I am printing out the comparable sales. I'm making notes about each comparable. We know the inventory. And if the agent deleted the photos from MLS, we're going in to see if they're on Realtor.com or Zillow because they're typically still there. And we want to see what the interior looks like. Did it have a new kitchen? Did they just put in the cheapest stuff? And, because the more notes we can provide to them, the easier we can make their job, the faster I can get the appraisal back, and I can hopefully get my value to where I want it, because these are the comps that I use to price the home at where I did, and they may be using other comparables that don't match the property. They're just pulling the top 3 that hit their search, and that's what they want to use. But this is what we're using, and 98% of the appraisers are happy to take your information.
Yeah, that's always been a misconception that appraisers don't want to be bothered with any information. That's bullcrap. They love it, and every appraiser that I have on my panel, I know personally. I've been doing business with most of these guys for 20 plus years, so they're friends of mine. I have them on speed dial on my phone. I probably shouldn't be saying this because I don't think we're supposed to talk to them, but I don't care. I mean, the most important thing to me is communication.
Yep.
And that includes our appraisers as well. So that's super important, Todd. And I think also just preparing your clients for the options if the appraisal does come in light. What's our plan of attack? What are we going to do? And even having that discussion with a listing agent so that all parties are aware and ready if that happens. I think.
Exactly. So as the market's shifting with rates and things, I know we went from 3% to 6% in 60 days. And then they feel like they settled down in the 5s, which was great. And all of a sudden we had that 3/4% rate hike. What are you seeing right now? Let's just say we don't want to project into next year, but like the next 90 days, do you forecast like some crazy increases, or are you still seeing that we'll be somewhere in the mid 6s, potentially getting back below 5 with some settlement, or where do you see things right now?
Man, the $1 million question. I mean, I'm keeping such close tabs. I'm watching Barry Habib every day. I'm just looking to see what's happening. The main thing, our main enemy when it comes to rates is inflation. So the bottom line is we got to get inflation under control. If that happens, if we start to see inflation start to head back down, then we're going to see rates head back down. Can it happen? Absolutely. I've heard a lot of analysts say that we may have peaked on inflation. I've heard others say that we're probably going to go up another point or two. And with inflation, that doesn't mean the rates are going to go up another point or two. But we keep a really close eye on what the feds are saying. And so when they meet, even when if they increase the rates by 0.75%, it didn't necessarily mean that our rates increased 0.75%. A lot of times the feds will raise the rates and our rates will actually go down because they've already priced that increase into the market. So the best advice I can tell you is, number one, stay in close touch with your mortgage professional when it comes to rates. We send out our pre-approvals and we're actually hedging the rates up a little bit higher than where they are, just to give a little bit of buffer room for those clients. So when they're shopping for that house, if they're maxed out on that payment, we know that chances are the rate's going to be a little lower than what we quoted them, and give them a little bit of wiggle room. The other thing too is we're starting to see ARMs come back. So the adjustable rate mortgages, particularly the hybrid ARMs, which are the ones that are fixed for a period of time, anywhere from 3 years up to 10 years, then they become adjustable. Those are becoming popular as well because their rates are a little bit lower than what the 30-year fixed are.
So I wanted to talk to you about the adjustables as well. So two things I want to interject on. Barry Habib has been like the leading mortgage, I don't want to say analyst, or speculator, maybe that's the word, But how do people follow him? Because his name is thrown around a lot, and he seems to be on point with things. So how do consumers find him?
Yeah, his website is the MBS Highway.
Okay.
M as in Mary, B as in boy, S as in Sam Highway. You can join, like we have a membership, so we get privy to a little additional information that he provides, and a lot of tools on his website. I can tell you this: as a real estate professional or a mortgage professional, I highly recommend spending whatever his membership is. I think it's probably $200 a year or something like that, maybe even less, to join. It's worth every penny because this is so important. Being able to know what the market is doing and be able to educate our buyers on whether this is a good time to buy or whether to wait, whether to lock in a rate when they go under contract, or whether to float that rate and maybe wait a little bit. All of those items are they're super important financial decisions for these clients. And his advice can save literally thousands and thousands of dollars. So I highly recommend following Barry.
No, I'm going to check out the site and potentially get into his thing because I want to see the daily updates, and I like when I hear his name. I like the stuff that he throws out there. He's just very easy to listen to as well. The other part I wanted to interject on you personally with the way you present your approval letter. So let's just call the rate 5%. You're going to give me an approval at 5.5. And this is what the consumers need to understand. It doesn't mean that the rate you're going to get is 5.5. So when you go and you see 4.75 or 4.5 on Quicken Loans, you may be able to get them that same rate. But what you're doing is knowing that I'm not going to lock in at 5.5. That's just what we're quoting you right now because the rates might go up a half point. Now we're at 5.5. And guess what? You're still approved versus, and I think it's smart what you're doing on those approval letters. But we also have to educate the consumer that this is just a quote. 4.75 is going to change tomorrow. Go check it out online, and see what's, what Quicken or whoever's on there does, or Lending Tree. You can see all the rates. They change all day. And so it knows that peace of mind that I might have a little fluctuation in price that I can show my clients as well. Because when I'm shopping houses for them, I'm pulling 500 to 550. Normal market, I'm going to pull the 550, think we get it at 525. But if I did get it at 550 and I know they can still qualify because we had that fluctuation there.
Yeah, it's a great topic, Todd. And so one of the misconceptions out there is that we as loan officers approve somebody up to a certain sales price, and that's simply not true. What we approve clients for is a maximum payment.
Yep.
So like we have an application, you're well aware of it. We send it to our clients and to our realtors when we pre-approve a client. And what it shows is what their max payment is. So we're going to give them a good idea of what that's going to buy them in today's market. We're going to say, hey, you're going to be around 300,000 probably. But if you find a house for 350 that's got really low real estate taxes, well, guess what? They might qualify for that house. So we're gonna consider that into the this is why the application is so effective and powerful, because it literally to the penny will tell you how much your client can qualify for. Now with the rates, obviously we know there's some wiggle room, and this is where that communication comes into play. So if you have a client that finds a house and they fell in love with it and they're ready to make an offer, that day before that offer is made, it's important to call us and say, hey, here's the address. Let us look up taxes. Let us even get a quote for homeowners insurance on that house as well before you even make the offer. And that way we're not wasting anybody's time or money or effort. We know for a fact that client's going to qualify for that house. And we can even tell them how much their payment's going to be. And we can tell them how much cash they're going to need to bring to close. So that's how we like to do it, to make sure we take any of the guesswork out of that equation.
No, I like that. When you want to sell on payment anyways, and if I'm looking at stuff because taxes may be low or it's in a different neighborhood, the HOA fee is different. So you got to look all the way around to what the payment is versus what the price is, because that $500,000 house that now has a CDD on it, it's another $300 a month. I can't qualify because I'm now at $400 because that's something we didn't know about. So that's why I like to see how, when you qualify on payment, where all the numbers lie. What is the principal? What is the interest? What are the taxes and insurance? What are your breakdowns there? And
Yeah,
did it have an HOA included?
and that can make a huge difference. HOA, especially if you're looking at condos or townhomes.
Yep.
That can make a huge difference in a monthly.
Yeah. So you mentioned ARMs. Let's talk about that as we're wrapping up. I've got 3 things I want to ask you. Adjustable rate mortgages, why are those so valuable right now coming back out? And are you seeing those come in lower? So if the rate's 6%, what are we seeing on an adjustable?
Yeah, I mean, we're not seeing a huge difference. We're seeing probably 3/8 to maybe a half a point difference on the adjustables from the fixed rate.
Okay.
But if you're talking about $400,000 or $500,000, $600,000 finance, then you're looking at a big difference in your monthly payment. The reason why these hybrid ARMs came about in the first place was because the lenders took a look at what the average is that somebody holds on to their loan. Now, everybody likes to think that they're going to buy a house, they're going to get a 30-year fixed rate mortgage, and they're going to keep that mortgage for 30 years. When the fact of the matter is, the average person keeps a loan around 4 to 5 years. That's it. They either sell the house or they end up refinancing the house. So this plays right into that. This plays into what that average, the national average is for somebody holding onto a mortgage. And it's going to give them that security of knowing that that rate's going to be fixed for that period of time. So if we're doing what's called, let's say, a 5/1 ARM, a 5/1 ARM is going to be fixed for 5 years. Then it's going to become an adjustable rate mortgage, and it's going to adjust one time a year for the next 25 years.
Okay.
So what a lot of clients will do is they'll say, hey, give me the 5/1 ARM. I know it's a better interest rate. And within 5 years, I'm probably going to refinance it anyhow. The crazy thing is that a lot of people that have had ARMs love ARMs, even after they go into the adjustable period, because the thing is that they're going to be tied into the same indexes that the fixed rate's going to be tied into. So when they go to refinance, let's say the rates have dropped down. Let's say they start at 5.5, and after 5 years, they can fix it out at 4.5%. Well, guess what? Their rate's probably going to adjust down to 4%. So a lot of people ride it out as long as they can, and in some cases, they never end up having to refinance because the adjustable rate mortgages are always lower than the fixed rate mortgages are at that time.
We just got back from our EXP conference, and one of the ladies that was up there was talking about, her topic was, selling in a shifting market, and I want to call it shifting, more normalizing. So we have some inventory sitting there. But, back in 2005, they had the pick a payment program. You had 4 different options you can pick during the loan. She's like, I still have that loan today. I love it. Yeah.
Wow. That's a dinosaur. Well,
Yep.
That was part of the reason why we got into trouble back in 2000.
But she's someone who took the creative loan and did it right.
I mean, honestly, it was a great loan for a very small percentage of people. The problem was that it was being sold to a majority of people. And that was, one of the many reasons why we had the problems that we had.
Yeah.
That loan doesn't exist anymore. The good news for consumers is that it's really tough to get a loan today. As you know, the qualification process is really, really difficult. We're gonna go through and look at every piece of paper that you probably have in your house. We're gonna verify your income, your assets. We're gonna dive into your credit. We're gonna make sure that there's nothing out there that we didn't see, and then we're gonna get you approved for the loan. Well, that's good news for the market. When rates go up, all of a sudden you start to hear a lot of conversation about, oh, is the market going to crash again? Are we heading for another 2008? And I can super confidently tell you it ain't happening. There's too much protection for consumers and protection for homeowners because of this stringent effort that we got to make to get people approved. It's protecting everybody that owns a home out there today. So it's a really good thing. And that's one of the many reasons why we're not going to see another market crash like that.
And not to dive into the market crash, but my answer to that is there's too much money in the market, too much cash in the market, I think, for number one. And two, if the market went down 10%, it would only affect the people who bought in the last couple of months, not the last couple of years. And we're not going to expect it to, we might see a 5% drop or 3% drop or something, but that's going to be short term while it bounces back up because of inventory and people coming in. Now, was my market value 500 when I did a price reduction to 475? No, the market was probably 450, and you're going to probably sell at that. So it's not that the market's down 10% because you couldn't sell it at 500,000. You just thought the house is worth that, and the market told you it was worth differently. In the overall. So you've got another program that's out there, and I was trying to understand this one for a minute. It's called Lock and Shop, and a lot of lenders are coming out with that. What is that? And I love it, good and bad. But can you describe that for a second?
Yeah, so it's exactly how it sounds. So it's for a client that we've gotten pre-approved, somebody who maybe has concerns about what the future holds for interest rates. So this program allows them to lock at whatever the market rate is today, and then it gives them about a 60 to 90-day window to be able to find a house and close on that house. So it's not a long-term lock. It's not something where they're locking and protecting themselves for the next year. It's, hey, I'm in my window to buy right now, and I really got some major concerns. We see sometimes clients will talk to their financial advisors, somebody, that tells them, put down where we can float that rate down to what the market rate is. And we do that in the last, usually the last 15, 20 days before they close on their house. That's when we need to see that market change. So it does give some flexibility for clients to be able to still take advantage of a lower market. I talk to every client individually about this to see if it makes sense, because it doesn't always make sense. This program, just like any lender that offers this, it's going to have a cost to it. There's an upfront fee that you have to pay in order to lock in that rate. So if they're really close to finding a house, I don't recommend it. If they're just really concerned though about what the market is, then this is something that could be good for them.
Well, it's an interesting program, and I like it because it does give us the opportunity to say, I know my rate's going to be 6%. Now, I did have a question about the lock going down or the rate going down. Can I get out of it and get the lower rate? But you can. You have a one-time float option down, which is awesome.
Yeah, absolutely.
Thank God it's not a float up.
Yeah, no float up, but float down.
That's awesome. So last question I have, and I wanted to talk about something else, but we're pushing to the time. But what can sellers do to be creative with the buyers that are getting scared right now? With the rates. So a lot of things are coming out, and I'm going to give you some ideas and tell me if they're good or bad. We'll pay closing costs for the buyer.
That's good.
Okay, so can I, buy the rate down a point? What kind of money does that look like? Let's talk a $500,000 purchase, 20% down, and my rate 6%. If I wanted to get the rate at 5%, is it a good idea to do that, to have the seller pay that? And how much does that usually cost?
Yeah, well, where this would benefit the seller and the buyer is if the buyer needed to buy the rate down some to qualify. So if we're really, really tight on our ratios and we got a good qualified buyer, but he's just a little bit above, and he just doesn't have the funds to be able to buy that rate down, this is where the seller could come in and contribute to make the deal happen. A percent or a point is 1% of the loan amount. So if the client is financing, let's say $400,000, then 1 point is going to cost $4,000. And it's just going to be rolled into the buyer's closing costs at closing. So it's not an upfront fee. It's not charged unless the transaction closes.
No.
Now, generally speaking, a 1 point charge or buying the rate down with a point is going to buy the rate down about 1/4 to maybe 1/2%.
Okay.
Depending on how pricing works that day. And again, depending on the loan amount, this could affect the buyer's payment by probably around $25 or $30 a month, up to maybe $75, $80 a month.
So not always the best move, because you got to know how long you're going to be inside the house and other options. And if you can't qualify an $80 a month difference, probably buying something that's too expensive.
Yeah, I mean it's pretty tight. I mean, we see it happen every now and then. Sometimes the buyers just want that lower rate and they want to be able to buy it down. And if the sellers are, if there's wiggle room, there's room to negotiate, then that certainly comes into play as well. I mean, there's a lot of times where we're quoting rates with a point, and we're telling the clients about this up front. When we see these crazy jumps in the rate, sometimes 1 point makes a big difference. I've seen it make a 1 point difference on the rate. Buying the rate down a point actually lowered the rate by a full percentage point, which is crazy. That's a no-brainer for a client. If they could ever get that, that's a no-brainer on the savings.
That's an all day long. I mean, we've got to get creative now. And Laurence, I want to thank you for being here today, just trying to answer some mortgage questions. We can go on and on about different scenarios, and maybe it's another combo. One thing I want to go into a second conversation with you to talk about the Florida Heroes program. And because we're at the top of the time, I want to put this into a second call, but let's book another time to talk just on that. Or maybe when you're in the office again, we can really just focus on that as a show or a call. Because that's a down payment assistance. It's not really down payment assistance, and you can use that for additional cash. So it's like wherever we can pull money to help buyers out, we want to use that. So Laurence, again, thanks for being here today. Any last words we want to throw out there?
No, I really appreciate it. I thought we hit some really good topics today, and I look forward to the Hometown Heroes conversation. There's over 2.5 million heroes in Florida alone, and every single one of these are candidates to receive up to $25,000 to help them buy a house. This is money with zero interest on it. So, I look forward to that conversation, and happy to be on the show, Todd.
Awesome. Thank you, guys. And again, subscribe, check us out, all the social channels and podcasts as well. We'll see you guys in the next show. Thanks, Laurence. Appreciate you.
All right. Take care.